In the 1950s, a financial advisor named Robert Kirby had an experience with a client that would change the way he viewed investments forever.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Robert Kirby was sitting at his desk one day when a client of his, who had been with him for many years, came into his office. She said her husband had just passed away and she needed to consolidate his assets with hers. So she handed Kirby the investment statement, and Kirby looked at it, and at first he was pretty amused. It turns out that the husband was piggybacking off of Kirby's advice. He was copying all the buy decisions that Kirby was recommending to his wife. But when Kirby got to the bottom line total value of the account, he was shocked. Let's say that this line on the left represents Kirby's investment management style. And this also equals what most investment advisors and other investment advice typically adheres to. And on the right here is the husband. We'll call him the coffee can husband. So let's say the client comes to you and says, I have $1 million and I would like to invest that in a portfolio of stocks. So what Kirby and most advisors would do is say they pick 50 different stocks, which they think are going to perform well over the next, say, 6, 12 months. And they put a 2% allocation in each stock. So if we did that, that would be about $20,000 in each position. Okay, so we've got $20,000 in stock A, $20,000 in stock B, and $20,000 in stock C. And then we have a bunch of others. But as time goes on, the value of these stocks is going to change. So let's say stock A was a big winner and actually doubled in value. We'll say stock B was a big loser and actually dropped by 50% down to 10,000. And then we'll say stock C just did fine. It went up by 10%. So this is after, say, year one. So what Kirby and most other advisors would say is, well, you should sell this stock, take some of your profits, and you should increase your weighting in stock B and maybe a little in stock C. So they would go through a rebalancing and reallocate money from stock A to these others. So maybe you make them all equal again. So in year number 2, stock A would be 24,000, stock B would be 24,000, and stock C would also be 24,000. So you've taken $16,000 worth of these profits and reallocated them to these two securities. And now each of these stocks is back at an equal weighting, and none of them has a substantially larger impact on the whole portfolio than any of the others. But the husband did something different and very interesting. Rather than following Kirby's advice to sell stocks or trim stocks, he just put $5,000 in each position to start off with, and he didn't do anything else with it for the rest of the time. So in the same example, he had stocks A, B, C, and a bunch of others, and we'll say he had $20,000 invested in each one, just like the other example. But when this stock turned to $40,000, he did nothing with it. He just let it win. And this one, when it dropped to $10,000, he added no money to it again. He just let it keep on doing whatever it would do. So decades and decades later, he ended up with several positions that had basically been permanent winners. So one position was worth $800,000 compared with a $5,000 original investment. And some of these other positions were worth much smaller amounts, maybe $2,000. So over the time he owned it, he ended up losing 50% or more. There were others that probably went to zero, but he had a few positions that were worth a substantial amount of money and that more than made up for all these other losing positions. So the entire idea of the coffee can is really based on math. So the coffee can husband put $5,000 in each security. So the most that you can lose in this stock or any other stock is 100%, unless you're leveraged, of course, but let's say you're not leveraged. So $5,000 worst case scenario is going to go down to be worth nothing. Okay, so this is the worst case scenario. The best case scenario, though, is virtually unlimited. A $5,000 initial investment can go on to be worth 5x, 10x, 20x, 100x what you originally paid for it, while the most you can lose is minus 1x. So as long as you pick, say, 50 stocks, and just a handful of them, even 5 of them, go on to be extremely big winners, you can offset a bunch of losers by the gains that you make. So traditional advice over here says that you should take money away and reinvest it into some of these losing positions. And of course, that could work out. If these losing positions eventually come back and turn into winning positions, then this is a good idea. However, if these positions just continue to head down towards mediocrity or bankruptcy, you're taking away from some of your most dynamic positions and adding them to some of your least dynamic or biggest future loser positions. So now I'd like to go over 5 real-life examples of the coffee can, starting with the least compelling and moving up to the most compelling. And like I said, number 1, I think is really going to surprise you. In my last video, I talked about my portfolio that I started in May of 2020. I started 5 different portfolios with $1,000 each, and each of these portfolios contained 30 different stocks. I ranked them each based on different valuation metrics. So one of the portfolios was ranked the highest earnings yield or lowest PE stocks. Another one was ranked based on the highest 30 dividend yields. I also had shareholder yield and a couple of others. My goal with this experiment was to see which of these 5 valuation ratios was the best. What I ended up discovering, however, was that the coffee can might actually have something to it. You see, I basically forgot about these portfolios. I had intended to rebalance them periodically, and after 2 years, I checked it in May of 2022, and all 5 of these portfolios outperformed both the S&P 500 and the S&P 500 Value Index. And in most cases, it was by a pretty substantial amount. Now, if you look at the portfolios, which maybe I'll do a video on in the future, it's very interesting to see that some of the stocks, like Occidental Petroleum was in there, that stock is up nearly 400% from 2 years ago. So that stock has become an increasingly larger percent of the overall portfolio, and its influence has been magnified over time. Conversely, a stock like Gilead has basically done nothing, and so it is becoming an incrementally smaller influence on the portfolio. But this whole time, I've taken no action in the portfolios, and all 5 of them have beaten the S&P 500. Before I share this next example, I have to say that this video or my channel is not associated with the firm, the investment firm that I work for. I'm not going to share any names or details about this particular account. I'm just going to tell you the story. But back in 2016, our firm had a client sell a business in an ESOP plan. And basically all that means is that they were able to defer paying taxes on their business sale. However, their investment portfolio that they rolled the money into had a cost basis at $0. So whatever they put into this portfolio, if they ever decided to sell it, they would have to pay 100% of that in capital gains. So the client came to us and asked us to build a 50 stock portfolio that we would basically own for the rest of the husband and the wife's lifetime. So our investment team and this advisor put together a list of 50 stocks, and most of these were just household businesses, nothing too extraordinary on growth, just the kind of companies that you would want to own for the rest of your life. Of course, there were some good performers in there and some bad performers, but as a whole, this portfolio, last time I checked, was slightly outperforming the S&P 500 over this time period, and that's even with having very little technology exposure. So even though technology has done exceptionally well from this 2016 to 2022 time period, this portfolio still outperformed. The S&P 500 index was founded in March of 1957. Jeremy Siegel went back and did research on those original 500 holdings, and his conclusion was absolutely fascinating. Siegel wondered what would have happened if you had just bought the original S&P 500 companies. Let's say you made no changes that entire time. So any spin-offs from companies, you just left them in the portfolio. Any dividends that were paid, you just reinvested those back into the parent company. How would this portfolio have done compared with the actual S&P 500, which has constantly been added to and subtracted from over many decades? You would think the S&P 500 would do better since you're adding new names, like new technology names or new businesses that come up that are innovative. But it turns out that the original 1957 portfolio, taken no action on, so this total descendants portfolio, these are a couple other methodologies that I used, but this was the true set it and forget it. If you started with a equal weighting of all 500 stocks at 0.2% each, that portfolio generated a geometric or compound annual return of 12.14% per year. If you weighted each of the 500 by market cap, which is a little bit more fair because that's how the S&P 500 does it. So you weighted all of them at the start, all 500 companies in 1957 by market cap, and then just left them and did nothing to them. That portfolio generated 11.4% per year, which again outperformed the actual S&P 500 index over that time period. Not only that, but the standard deviation of this initial market cap weighted portfolio was 16.1% per year. Compare that with the S&P 500 at 17% per year. And not only was this original portfolio a better performer, but it had less risk, at least as measured by volatility. The Sharpe ratio measures the risk-adjusted return, and you can see that it's substantially better than the actual S&P 500. Now, of course, this study only goes through the end of 2003. To my knowledge, this study has not been updated, but if anyone knows otherwise, let me know in the comments down below. Number 2 on the list is Berkshire Hathaway. Since 1965, Berkshire Hathaway has generated 20% per year returns compared with just 10% per year for the S&P 500. Of course, this business is run primarily by Warren Buffett and his partner Charlie Munger. Buffett gets the reputation of being a value investor. However, I actually think Buffett is more of a coffee can investor. They do focus on buying undervalued businesses, but I think the most important thing they're looking for is a great business that is able to compound its returns over time. And the longer you own a wonderful business that's compounding its earnings year after year after year, the more money you're going to make, and you're going to do absolutely nothing to earn that except for make a good decision to begin with. There are many examples in the Berkshire Hathaway portfolio, but here are just a few. They bought Washington Post in 1973, Coca-Cola in 1988, American Express in 1994, and they completed the acquisition of Geico in 1995, but the history with that company goes back to the 1950s. And of course, most recently they bought Apple in 2016. They paid $36 billion for those shares, and is now worth approaching $200 billion. And the common thread of all these big winning great investments is that they bought them decades ago, and they really have not done anything to them since, other than maybe add to them or completely buy them in certain cases, but they've never meaningfully trimmed any of these. So for example, Apple now makes up over 40% of their public stock portfolio. They've made these purchases and then just let them grow essentially indefinitely. And I think this is an underrated component of their success. And Buffett even admits, he says, lethargy bordering on sloth remains the cornerstone of our investment style. And I think Buffett really means it. Doing nothing is an essential part of their strategy. And the number one best example of the coffee can portfolio that I've ever seen is the not widely known Lexington Corporate Leaders Trust. It's now been purchased by Voya, but this was the original name back in 1935. This fund was founded before the Investment Act of 1940, which means that regulations prevented them from making any changes. So they bought 30 different Depression-era leading companies back in 1935, and they literally have done absolutely nothing since then. Some of the businesses they bought include Allied Chemical and Dye, the American Can Company, American Radiator, and Standard Sanitary, AT&T, Columbia Gas and Electric, F.W. Woolworth, which eventually became Foot Locker, and then, interestingly enough, they owned shares in Burlington Northern Santa Fe, which eventually became Berkshire Hathaway when Buffett agreed to finance the acquisition with stock, which is something he rarely does. Other names included DuPont, General Electric, and Procter & Gamble, which has actually gone up 120 times from when the trust originally purchased it. You can look this fund up on Morningstar under the ticker LEXCX, and the portfolio as it stands today is quite interesting. There are 19 holdings currently, and 94% of the assets are in just 10 companies. 43% of the portfolio is in Union Pacific, 14.4% is in Berkshire Hathaway, Linde, Exxon, and Marathon all make up over 5% of the portfolio. And then you have some smaller positions in Chevron, PG, Comcast, and others that are around 1% of the portfolio. So again, we see this extreme concentration that originally they bought just 3.3% of Union Pacific, or whatever eventually became Union Pacific, and now it's worth a huge concentrated 43.8%. So you would think a portfolio like this would not perform very well, but it's shocking how well this fund continues to do. Here are the returns as of May 17th, 2022. Over the last 15 years, this fund has generated 8.6% annually. And that compares with the average large cap value fund doing 6.7%, and the S&P 500 index doing 7.5. So over the last 15 years, this fund that has taken no action since 1935 has beaten the market by 1.1%. And remember, this is including an investment fee, which they charge about 0.5%. So if you add this on top of this outperformance, assuming you just own these stocks without a fund wrapper, this would be outperforming the market by 1.6% per year. And even in recent years, this fund has done exceptionally well. It's outperformed over the last 5 years, 3 years, 1 year, even year to date. This fund is actually up 4.3% year to date. Everything else is down. This is up on the 3 month, the 1 month, the 1 week, and the 1 day. So why does this coffee can portfolio concept seem to work so well? In the next video, I'm going to share with you the 7 reasons why I think this is an extremely effective way to manage investments. Click right here if you want to watch that video. Thanks for watching, and I will see you in the next one.